Very good evening. Welcome to today's webinar, Career Insights into Structured Finance, hosted by CFA Institute and CFA Society India. I'd like to take a moment to welcome our audience from around the world joining us remotely. I am Rajendra Kalur, CFA, Independent Management Consultant and member on the board of CFA Society India. I'll be the moderator for today's webinar. Before I introduce our speaker, I have a couple of housekeeping notes. Today's webinar is scheduled for 60 minutes, including Q&A, 40 to 45 minutes of the presentation, and last 20 minutes for Q&A session. We'll be leaving time for Q&A after the presentation. Please also feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A link at the bottom of your viewer and typing your question in the box. The webinar presentation will be available to view after the presentation concludes in the chat box. We value your feedback, so please complete the evaluation survey before you sign off today. Now it is my pleasure to introduce our speaker for today's webinar, Saurav Mishra. Saurav Mishra, CFA, is the Head of Structuring Global Markets India, HSBC. He's also an active volunteer and past board member, CFA Society India. He has more than 2 decades of experience in the finance industry. Before joining HSBC, he led the distress financing business in India for Deutsche Bank and also worked with HDFC Bank and Tata Steel. May I welcome Saurav to begin the presentation. Over to you, Saurav.
Thank you very much. It's a pleasure to be before all of you. So I'll start now with the presentation. The broad way I'm putting the presentation up is to introduce the subject a bit more in detail, and then we'll go with the components, the market, the ecosystem, and the opportunities. All of this are linked, and of course we'll talk about in the end about the CFA curriculum and structured finance itself. All views are personal. So what is structured finance? It is opportunistic and distinct from the normal corporate finance. The most important part is it is driven by typically the client requirements. So a normal bond issuance, a vanilla bond issuance, a usual debt raising, a usual loan, and a structured finance are different markets by intent, nature, complexity, and a number of other factors. So is structured finance only about debt? No, but it's understood a lot to be about debt than equity. There is structured equity finance as well, but primarily what we are going to talk about, and the area which I know more about, is debt. And of course, you'd see from time to time there will be equity related components which come in this structured finance, but primarily it's a debt market driven area. Now, can they be market traded? Are all structured finance debt products or the offerings or the solutions by nature illiquid? No, not necessarily. Some of them are actually traded, and some could be syndicated as well. And when we talk about syndicate, essentially we talk about distribution of risk. Risk could be parceled out, risk could be kept in different forms, it could be sliced and diced. And structured finance by itself, if you look at the area, it is vast. So what would be a good idea is to sort of take a rather arbitrary but nonetheless important division on 2 areas, which is special situations financing and distress financing. I'll just run you through a few examples. Many a times explaining something becomes easier if you take examples. So take special situations. Special situations financing is, by example, you would see acquisition financing, you would see securitization structures, you would see sponsor financing. When you talk about sponsor financing, you talk about sponsors, large multinational sponsors having equity in various operating companies, and they want to leverage. That's a classic sponsor financing on unlisted equity. Equity collateral backed fixed income financing. Holdco companies who have let's say, a successful company running for which they are holding equity. And this equity is traded, is listed. Now they intend to, the promoter intends to leverage on these listed equity and looks at raising financing, a debt financing. So he pledges the shares, raises debt financing, classic equity collateral backed fixed income financing. Uh, Specialized bridge. You are looking at a long-term financing, but right now you're only looking at a bridge. So specialized bridge, mezzanine financing. Before you go for a capex, you do a financing before you raise the actual long-term money. You have credit enhanced financing where you get guarantees, you structure guarantees, indemnities. The examples are numerous, and there is no what you can. It's not expected to be exhaustive, but examples give you a clue about what broadly structured financing is. Now, special situations, market and key participants. While we have kept distressed financing slightly different, but let's sort of look at what are classic market participants. Now, of course, corporate counterparties are there, but if you look at it, investment banks have been traditionally the key conduits in developing this market, offering solutions to the clients who require those solutions. You have other banking entities which do not necessarily are not necessarily investment banks. In fact, commercial banks also provide structured financing. You have specialized funds, and when you talk about specialized funds, they are credit funds. They are funds which are completely special. I'm not talking about again classic macro funds and all that who take major investments based on macro trends, but we're talking about specialized credit funds here who either specialize in a particular sector or are broad-based credit funds. Similarly, you have financial institutions who are either by charter or by nature of investment. Take, for an example, pension funds. And pension funds are involved in structured finance in different ways, in different forms, particularly large pension funds. You have non-bank finance companies. A lot of non-bank finance companies specialize in certain portions. So you have NBFCs who are in real estate. You have NBFCs who specialize in particular type of financing. Alternate investment funds, post the SEBI regulations on different types of AIFs, have become a popular route of investments into India and for that matter, local investments as well. They are, there are different categories of AIFs, and their purpose is to look at precisely specialized situations, special situations, uh, and they cater to a wide variety of financing requirements of the market. Foreign portfolio investors could be by themselves uh, registered. Foreign portfolio investors are basically registered entities under SEBI, and as they are the vehicle through which offshore investors come into India and invest in rupee bonds. Important part is the FPIs by themselves could be basically FPIs of banks, offshore banks, could be FPIs of offshore pension funds, offshore specialized funds, or any other offshore counterparty, even offshore corporate counterparties. And then there are again specialized vehicles, specialized securitization vehicles, SPVs, and all. So all of these are participants in the special situations market. Now, because we have, for ease of understanding, divided the entire thing into distress financing and special situations, it has developed as a distinct specialization in the market itself. Uh, it is an established financing area, particularly if you look at Chapter 11, the evolution of Chapter 11 bankruptcy in US and similar regulations in Europe. It has developed as it is much more developed and liquid in Western markets. In India, it's evolving, and a lot of impetus of this evolution came from the Insolvency and Bankruptcy Code. Is it a market which is worth looking out for? Oh, very definitely, and very, very important market, uh, which we expect will become just like developed markets, a large investment area for onshore and particularly offshore investors. Uh, Just to delve a bit on distressed asset space, if you look at the classic way distressed financing works, is that we'll divide it into primary financing and secondary investments. Primary financing are typically those one-time settlements where there's an excess leverage in the system, a new lender comes in, and that excess, the existing lenders exit either at a haircut, a certain amount of haircut or otherwise, let's say 60% of the original loan, 50% of the original loan, and a one-time settlement comes, a new lender sets in, all the old lenders go out. Priority financing is where there are specialized needs, working capital is required, liquidity is required, or additional funding cannot be done by existing lenders. And they bring in a new lender who's given a priority in terms of payment or security, and the new lender comes in. There are other forms of structured finance where in distressed primary financing where you carve out securities. There are multiple ways to go about it. But primary financing essentially means that you come directly to the corporate, become a part of the lending group, either solely as a consortium with lenders or otherwise. Unlike secondary investments, we actually buy out existing bonds, existing loans, or do it through a security receipt format, which we will not go much into the detail of, but it is also sort of an instrument which is an interest in defaulted loans. So secondary investments by nature could be uh, investment instruments rather than, or probably more in the nature of traded instruments where it is possible, or in the nature of not looking at getting into the capital structure of an existing entity or altering the capital structure of the existing entity. It is possible this line becomes sometimes thin when you're actually working through the entire restructuring process. But again, investor space is probably another way to look at it. There are specialized distressed funds and large ones in the market. I mean, the ones, just to sort of quote a few international ones, Oak Tree, Lone Star, uh, etc. They are asset reconstruction companies. Asset reconstruction companies are again specialized licensed vehicles, licensed under RBI regulations, who specialize in the entire restructuring process. They issue security receipts, they work along with the existing lenders and new investors and provide platform for resolution of the assets. And of course, financial investors could also be banks and NBFCs themselves. And foreign banks, particularly, have seen to be financial investors in distressed financing space. Strategic investors are by nature different. Financial investors are looking at financial returns. Strategic investors are basically looking at taking over the distressed asset if they see value. And companies are obviously a classic example of strategic investor. There could be others like private equity firms. And that's also an emerging area where private equity firms could come in, could get into a distressed company, look at a turnaround, and look at huge equity value accretion. Now, it's a good way to just take a pause here and look at coming back to just a second. If you look at the structured credit India and developed markets, there are differences. First is size, and structured credit is structured finance is a broad term. So it's very difficult to say, and a lot of these deals happen on the private space, not necessarily on the market listed space. So it's difficult to sort of pinpoint a number, but you could look at some areas. For an example, if you look at securitization as a part of structured finance, uh, India alone probably you could look at sort of 28 to 30 billion dollars in terms of securitization volume. Uh, and if you look at the global market, it's more than $1 trillion. So not necessarily all vanilla securitizations fall under structured finance, but that's a good way to look at it. And we want to know more about securitization. It's a good idea to sort of refer to an excellent paper of Vinod Kothari on the size of securitization market for comparisons. But market participants are different. In India, market participants, it's a developing market. So the market participants are foreign banks and specialized funds uh, coming in different forms because they are, again, the regulatory landscape offshore and onshore is again very, very different. The distressed acquisition market in India is developing. In US and other places, distressed acquisition space is very, very wide and fairly well developed. And there is a lot more of financial investor participation, particularly specialized funds participation. India, we expect it to come, but the strategic space, at least for the time being, probably will be more uh, 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 covered by companies and corporate counterparties who are interested in those acquisitions rather than the funds. And probably over a period of time, you would see financial investors also getting into it. Uh, Regulatory landscape is different, and regulatory landscape, if you look at it, key differences: restrictions on banks in doing acquisition financing. There are offshore investment regulations. Capital convertibility is not there. So there, but still you can invest. Offshore investors have been provided vehicles to invest into India, licensed vehicles, and there are, but there are restrictions which are different, which pose their own challenges, and the philosophy is also slightly different. The way a regulator looks at it is very different. For an example, there is restriction on local money being used by foreign-owned and controlled enterprises in leveraging if it is not an opco. So I'm not going to go a lot into the technical aspect of it, but the regulatory landscape and other considerations, size, liquidity, market participants, they are different. Will it converge with the developed market? It would definitely grow. It is already growing. It will definitely grow. Convergence is not exactly the aim. The idea is, in its own unique ways, it needs to grow. Structured finance market is India new to it? No, it is not. It is in various forms and facets. Has always been there, and last 5 to 10 years, it has only developed. A good way probably to look at is the number. And when I was speaking about, if I just go back to uh, enactment of insolvency and bankruptcy code, I thought it's not a bad idea just to sort of spend some time on looking at data. I'm just going to flip through the data. And there is a reason. If you see, I've put the insolvency resolution data is basically from Insolvency and Bankruptcy Board newsletter, and I've necessarily and pointedly kept the March 2020 data, so it doesn't get so you all get a from inception understanding prior to COVID. And see, a good way to look at how the market is developing is like this. You had admitted 3,774 cases, closed on appeal review 312, closed by withdrawal under 12A. Will not go into all the details. Closed by resolution is 221, and that's a fairly significant number. Ongoing CIRPs, and where CIRP is corporate insolvency process, resolution process, greater than 270 days are 738. I'm talking about the timelines, and timelines are very interesting. 738, 494, 561, 377. How do you look at it? Now, one of the key parts of the data is almost 57% of the resolutions, if you look at the data, resulted in order for liquidation. But you should also appreciate that a lot of transfer happened from the BIFR, the erstwhile Board of Industrial and Financial Reconstruction, to a lot of these were probably defunct companies. But the liquidation happened. And by the way, that also speaks volumes about what has happened in post IBC promulgation. Liquidations could anyway take between 5 years, 10 years, and have been cases of 15 years in India. That process, despite, I mean, could we probably be better at the number of days of resolution? Yes, but it by those records, by the earlier data, this is record timeline and a significant improvement. And most important, 221 resolutions and realization of financial creditors in compared to the liquidation value. When you go through the resolution process, the resolution value is actually calculated is 183%, and it is 45.96. All of this talks about a well-developing uh, insolvency resolution market, a very important pillar of a good structured finance market. Now, if you look at it, average time taken has been 415 days, including time excluded by earned, which is phenomenal, and it is expected to come down more and more. While we have seen or probably read a lot more about it taking a long time, resolution taking a long time compared to the intended original 270 days, etc., etc. But I would believe that it's, if you compare it to the actual on the ground status prior to the IBC, it is a great achievement and a good data to see. Now resolution time frame is, go through the Doing Business 2020 World Bank Group report and now see where is Mumbai in terms of time years compared to OECD, compared to Bangladesh, China, Delhi. Mumbai and Delhi are almost similar because they are part of the same data set. And see these numbers, and these numbers throw in sharp relief where we are. Both recovery rate and comparator economics are fairly decent. And you're talking about recovery rate of roughly 71%, 71.6. Now, so that gives you an idea of the evolution of the market. Now, what we'll do is we'll just flip through the financing process itself. The financing process key determinants are the investment strategy, sectoral expertise, primary or secondary exposure, strategic or financial. And here is uh, what what uh, uh, brings what sort of investor. Take for an example investment strategy. Uh, Classic credit funds or look at compared to a private equity a smaller time horizon, but that time horizon we are talking about could be anywhere between 3 years, 5 years, or in some cases a smaller time horizon. But they also look, banks probably have a much more broad-based sectoral expertise, if they're particularly if they have into this business, if they have project finance expertise, or if they have securitization expertise. But banks are not necessarily so much guided by sectoral expertise. Credit funds are sometimes, few credit funds are super specialized into particular sectors, and when they are looking at it, even if you keep distressed funds aside, they they are much more invested into taking exposures based on what outlook they have. So you could have funds which are devoted to probably oil and gas segment, or because of their evolution, the way they probably are offshoots of private equity entities who have specialized in particular industry. Primary and secondary exposure is a very important part of the financing process. The worldwide defaulted loans or uh, structured finance loans or certain type of bonds are traded. There's some entities which look at uh, trading out syndicating exposures. There's some entities who specialize in long-term hold exposures, and their approach, the way they look at the trade, the way they deal with it, is very different. Now, why are we going through all this? Because all of it matters when you look at the entire set of opportunities of what these companies present compared to the skill sets of people who intend to be in different parts of these entities and different desks. Now, strategic and financial obviously is very simple, and we'll concentrate a lot more on the financial sector rather than on the strategic part. But the strategic part is important because the financing process, many a times, if you have private equities investing in certain areas or looking at certain structured finance transactions, it is much more strategic in nature. Certain credit funds looking at it could be strategic in nature. Companies definitely, even if they are recipients of structured finance, have a very strategic view about what they are taking, what company they are taking, what sort of financing they are taking. And financial investors obviously look at it purely from a financial perspective. A classic structured finance, purely from a financial investor perspective, if you look at it, is an assessment, agreement on terms, diligence, execution, and closure. Now, this looks fairly simple, and the part which is important here is to look at assessment. You assess what sort of sector, going back just the previous slide, depending on your background, depending on what you are, if you're a bank, you'd probably look at it from a different perspective. A fund, you would look at it from a different perspective. But you would assess the situation of what structured finance is required. Let's take a bank. Bank is looking at an offshore banking entity is looking at financing for its client and acquisition. A classic acquisition will be an assessment of what company is being taken over, what will be the merged entity financials, how will it look, what is it, is an off balance sheet, is it based on equity, there are endless number of things. But finally you come to an agreement of terms. The agreement of terms means the broad agreement of terms. A broad agreement of terms also means that at time when you have made certain assumptions, you go through the entire diligence process. Diligence process could be technical, could be legal, could be related to, let's say you are looking at a petrochemical plant, you'd be looking at hiring industry experts to look at this. You'll be looking at a steel plant, you could be doing something different. You have industry experts for each of these, you will have consultants, you will see that all the assumptions which you're making in the model are stacking up. Then you go assume that all the agreement terms, they could get modified because of diligence outcomes, because of regulatory or other structuring considerations, but you finally come at the execution stage where you execute a transaction. When you execute a transaction, that means you sign, you close everything, and execution and closure are very, very linked. Execution is a process of documentation, of going through. The closure is a process where you actually end up funding. And then, of course, you monitor. So while this cycle continues for each of them, so your job doesn't get over where, as a financial investor, you just have closed a deal. And this is a classic primary financing deal which we are talking about. Now, let's just go into a lot about what are the team structures usually. Team structures obviously change from place to place. So banks would have a different team structure, funds would have a different team structure. But if I just sort of use a common way to look at the entire business, there is origination, there and the origination could be coming from, let's say, debt capital markets, could be coming from banking, could be coming from specialized originators who have particular skill sets, and we'll go a bit into those details later. Then you have a structurers who basically look at the entire structure, what fits in, does this solve the issue. Then you have analysts who look at it closely from a credit perspective, present it to the infrastructure functions internally. Or if you have a fund, then you have an investment committee. They work, analysts and structures are yin and yang. They work very, very closely with each other. Origination is the front, are the people who are involved in the negotiation, are involved as a part of getting from the client what does the client want, and delivering to the client what works from analysts. So it's essentially the client representative for the deal team, and getting things across what the fund or the bank wants, and the client is the most important bridge. That's origination. Structurer and analyst work very closely together. They work also along with the risk manager, and risk manager is the trader. The trader is in certain places, structuring, trading are sort of merged together. In certain places, it is separate. Traders essentially are finally responsible for the risk. Structurers are sometimes involved in the entire risk management. Credit analysts post the trade also look at covenant monitoring, and covenant monitoring is also separately done by the infrastructure functions like credit or credit operations or portfolio manager in case of funds. Now, skills and attributes, and it will give you a broad idea of what skills and attributes we are speaking about. Originators are relationship guys, so they need to know promoters, they need to know people around, they need to know industry participant. Structurers are not necessarily promoter or direct relationship guys, but they definitely are. They work closely with originators and analysts. Analysts are much more of an industry expert. They many times specialize in particular industries. They understand particular industries, or they go into that in depth into that area. They are much more related with the particular nuances of credit into the industry. Structurers are people who work a lot with the regulatory part, the overall structure, how payment should be worked out, what are the credit covenants which should work along with analysts, and what could work given the corporate structure and particular needs. So they work closely with originators, they work with analysts, and they also work with risk managers. And traders are essentially the one who take the call. And if you take classic fund manager concept in a fund, they look at the final assumption of risk, and they need to risk manage it during the life cycle. They work along with the structurers in the risk management. They work along with the analyst also in the risk management. Originators are not necessarily involved once it is on the books. Skills and attributes of structurers is much more broad-based knowledge of they need to know regulations, they need to know the structural capital market considerations, the market, how should it be syndicated, how it should work. They should be able to have idea of credit, idea of a bit of idea of trading, bit of idea of origination. Uh, Analysts are much more specialized. You need to develop skills and attributes which are specialist to analysts. They need to have good modeling skills. They need to have a lot more quantitative aptitude compared to others. Traders, obviously, a lot of structurers develop into traders. Sometimes analysts also develop into traders. Traders are, or fund managers are, and depending on organization to organization, certain organizations they are there's hardly a difference between structures and traders. In certain organizations, traders are much more market oriented and not necessarily go into the nuances of the trade. They look at market, they are close about the risk management, sell off, etc. And they are a lot of it. What they do is credit risk, parceling out risk, how to trade with the risk itself. Unlike flow traders, structured finance traders are much more concerned about idiosyncratic and credit risk rather than the market liquidity itself. Now I'll go into the ecosystem, and ecosystem is a very important thing because ecosystem is where you see the broader opportunities for everybody around. There is this buy side, which essentially is corporate counterparties, funds, or any other institution which is looking to borrow. The investors is a word which is broadly used. You could also call it lenders. That is another ecosystem. There's rating guys who are involved in the rating process, and a lot of it, a lot of the stuff could be rated, unrated. Uh, there are the legal counsels who are very closely involved in the structure, the entire process. There are consultants right from technical consultants, financial consultants, specialized into uh, uh, various parts, including industry consultants. There could be financial consultants, market consultants. All of these people are part of, and then of course there are valuation. So for an example, if you're going to do a real estate investment, you need to understand how the value is being derived. There are valuation, specialized valuation agencies, general valuation agencies, financial valuation. For an example, all the big fours are a lot into a number of valuation and valuation related services. There are specialized valuation related services. Uh, or take for an example, you are investing into a debt product which is where the cover or the security cover is unlisted equity. Now you need a regular unlisted equity valuation. So broadly, this is the sphere, and opportunities are in all of this. And the most important part, and which is what I want to come to next, is that uh, people tend to work into different parts of this ecosystem. And the different parts of ecosystem, people tend to move from one place to another. And as we go about what are the typical hiring recruitment practices, and that's the interesting part of structured finance. See, the reason why we went through a lot on what is structured finance is to look at it that how broad based it is. And by very nature, which means that there is a significant amount of There's a significant amount of varying recruitment practice. And when you talk about varying recruitment practice, there's a fair amount of lateral movement into structured finance. There is also now, when I talk about lateral versus campus, let's speak about what lateral movement we talk about. See, uh, in all the four spaces, whether it is trading, trading has been a traditional bastion of investment banks or in certain places funds. But if you look at the structuring, credit analysis, and all, people from different places come in, and it is actually welcomed. So, for an example, if I'm a credit fund focused a lot on petrochemicals or petroleum sector, I would have analysts who could be probably engineers and probably will do a phenomenal job in understanding the technical aspects. If I'm doing a significant amount of distressed financing of petroleum sector itself, or for an example, if you look at the earlier part of the last decade, there was a lot of distressed opportunities in actually the exploration segment, oil exploration segment. There's a lot of in shipping. Now, there were a lot of financing also being done in the shipping area. When you're looking at that, people who have specialized knowledge of that are probably best placed to come in that. Project finance, another area, and a lot of project finance people probably come into this, a lot of engineers coming in. And let me give you a very good example of lateral placement. Regulatory structuring, a lot of banks actually hire structurers who have been practicing attorneys, and in US this has always been there. Uh, so lateral movements in structured finance is very, very common. You are specialized into, for an example, or you look to do equity-backed financing, you'd probably put equity analyst in debt funds who are specializing in that area. So it's wide and open, and it's a lot driven by what people are looking at. Does that mean that you don't see campus recruitments in structured finance? No, no. On the contrary, you do see campus recruitments where people are developing classic analysts. And the way you look at, if you go to the classic structure, it is analysts, associates, senior associates, principal. If you look at a fund, or principal, senior principal, managing director, fund manager. If you look at a bank, uh, so do you hire from campus? Investment banking entities are known to hire from campus, and they usually start with these people as analysts, gradually develop, branch out, specialize, go into structuring, and eventually land up in the same career path which banks have. Banks have a different career path compared to classic funds. But do funds also do campus recruitments? A lot of them do it. But do they also many a times hire laterally, particularly in the analyst associate stream in the 2, 3 years, 4 years segment? In fact, they do, and they are fairly open to looking at different variety of people because that's the nature of the business. Now, ecosystem versus in-house is a very important one. And ecosystem versus in-house is important because people not only hire from traditional investment banks, from funds or lateral movements, but a lot of hiring actually also happens from the ecosystem. That means when we went back to the ecosystem, you would hire from rating agencies, you would have counsels from the legal firms. A lot of hiring happens from the consultants. So you'd see movements from the large consulting firms into the buy side, into the investor. The buy side itself hires from time to time when they are looking at sort of strategic finance functions in their own firm, when we have their own M&A, buy-side M&A platforms where they're looking for a lot of acquisitions or raising a lot of financing. And you would see a lot of cross-pollination of talent across the ecosystem, which means that if you are in a credit rating agency working together, or if you are in a fund, nothing usually stops you. And you would probably see movement into a bank. You would probably see movement into one of the big fours, and from the big fours, a movement into a fund or so in a bank. Generalist versus specialist is a very, very important one. Just because you are a specialist doesn't give you necessarily a very, very good uh, leeway. Uh, in fact, specialists are important. Just a second. Specialists are important, but a wide-ranging experience is equally uh, considered important. A lot of people who have had experience from origination to structuring are an example. Origination to structuring to trading, all of that becomes important tools, important skill sets, which would makes you more employable in this segment. And onshore versus offshore is a very important one. Onshore versus offshore is important because a lot of uh, large investment banks, large funds have been employing in India. And while we have a lot of work, particularly analysis and structuring, is done out of the offshoring centers in India, and it may not necessarily require direct client interactions, and sometimes it does, but it gives excellent opportunity and exposure of structured finance in developed markets. And a lot of people are actually working in that area, and that's a good place to be in. Both, and it also gives you opportunities to move abroad when they look at uh, onshoring you. And there are multiple examples which I've seen in banks where I've worked, where people have started offshore and moved onshore. Last but not the least, now I will just go to CFA curriculum in structured finance, and that's I did my charter hold a long time back, and I must tell you that it helped me. The sheer length and breadth of the curriculum helped me in developing skill sets which are critical for the structure. I'm not originally from structured finance. I have worked in buy side. I've worked in treasury in buy side, in treasury sales and sell side, and then I've moved. I've worked across banks. I'm a chartered accountant. I've worked in audit, and I've moved to credit as a conscious decision. And when I moved to credit some time back, I remembered a lot about what I studied, and surprisingly, the CFA curriculum gives you a very broad idea, and it clearly helps you when you are dealing with actual problems, actual areas in structured finance, which could be as varied as how to value, how to look at a particular market, what are the basic things. Uh, it's absolutely phenomenal how important and how useful I've found what I studied during the CFA time much later when I was actually getting into this space. The network itself helps, and the growing network will help members to leverage upon specialist knowledge where you speak to charter holders in structured finance in a part of the market itself into understanding how to use, how to analyze a particular situation as well as the movements itself. And last but not the least, most important is the emphasis on ethics. And I can tell you, structured finance, the sheer foundation which of ethics which CFA Institute provides, being a part of coveted circle of finance professionals, uh, right from the time you study the curriculum to the time you become a member, it helps you navigate big time into the complex issues involved in structuring deals. Understand from a stakeholder's perspective, understand it's not only the legal or regulatory structure, it is also the spirit, and it is also the spirit of what is right and what is wrong on a much broader level, and taking right decisions about entering into a deal, structuring it in a particular form. And I can proudly tell you that uh, my entire learning on ethics has been very, very useful in this journey in structured finance. Thank you very much. I think we are over with the presentation now.
Thank you, Saurav. Really, a very good and comprehensive insight into the very eclectic and I must say esoteric world of structured finance is what you provided. And now it's the time for the audience question and answers. And I must compliment you for really tickling the audience minds. We have a wide variety of questions that will keep you busy for the next 20 minutes or so. So let me start off with the first one, Saurav, if you are ready.
Sure.
Yeah. So one of the questions that's common is in terms of, about the structuring, the legal framework and the architecture of, structured finance. You mentioned about a variety of players being involved in the structured finance. So what is the legal structuring and architecture that should be ideal for a structured finance entity?
So,
or is there one?
There is no simple answer to this question. The question is essentially the objective and the type of investment, the type of, if I've understood the question correctly, the type of financing requirement. For an example, if you look at acquisition financing in India, acquisition financing in India cannot be done by banks. So you have a client which is a corporate counterparty. It is looking for acquisition financing. If you talk about a vehicle here, if there is a non-banking finance company, you could probably use that. If you have an offshore entity which could provide financing, which is registered as an FPI, you could use that. So the legal and regulatory requirements are would require you to use either an FPI vehicle or an NBFC vehicle for doing it, or an AIF for doing it, but not necessarily a banking entity. So the question again arises on the type of financing. Now let's reverse this and look at it from an offshore investor's perspective. Offshore investor is looking at financing, let's say, an equity. Let's say it's financing a holdco based on a listed equity. Now, if it's financing a holdco based on a listed equity collateral, the regulations in India only permit an offshore investor to do so in a particular form. It cannot do an onshore loan, it could do a bond. So again, it is driven, the instrument. And if an offshore investor is looking to invest via a bond, he should be registered under the FPI regulations, satisfy the regulations. So it is a lot dependent upon the end use rather than a particular financing structure itself.
So there is no single vehicle. There could be a variety of legal structures, and also you might have to create a legal structure to get into a particular.
Sometimes, yes. For example, in securitization, actually regulation prescribes you to create a particular legal structure, a trust or an SPV, through which securitization could happen.
Other thing is in terms of how big is the MBS ABS market in India? I mean, this is about the size of a particular segment of structured finance. That's MBS and ABS market. Is the market liquid? I think that's also been put up by one of the attendees. And
I don't have offhand the MBS ABS market numbers with me, but I can tell you this, that it is a developing market. MBS is has been. I think the entire ecosystem wants the MBS market to develop. In fact, the new regulations are actually, particularly for residential mortgage-based securities, have streamlined and reduced actually the minimum retention ratio, which is I think now 5%, irrespective of the tenor. So there is a clear regulatory intent to develop that market, and it is a market ripe for development. Is that a liquid market right now? I would believe not. Are the asset-backed markets, particularly vehicle loans market and other markets, comparatively liquid? Oh yes, they are comparatively liquid. Do you see regular trading in this market? No, not really. A lot of securitization also in India could be related to primary sector lending.
And any idea how to access these pool of the structures? You mentioned it's not liquid, so obviously not on the secondary market, but I mean, who would be holding it? How do you access these?
No, so see, there are a number of market participants in this. So, for an example, you could have banks holding it, non-banking finance companies, uh, mutual funds. You could have theoretically foreign portfolio investors. So, classic securitization structures are pass-through certificates, and pass-through certificates are pretty popular in India in that sense. There is significant amount. If you look at include everything, including direct assignments, you are talking about 28 to 30 billion dollar of the total size of the market, securitization market itself. So,
Yeah.
are there various participants in the market? Yes. Do people invest into it? If you look at just the securitization market, there are two parts of the market. One part of the market is the RBI-led securitization market, which follows the RBI regulations, and the other part is SEBI-led securitization market, which is the listed rated market of securitizations. Is is the market poised for more development? No doubt about it. Is it a market which is tremendously liquid, fairly traded? No, not compared to most of the other bond and other instruments.
Yeah, thanks, Saurav, for that. But let me just quickly, pivot on to the career part of it, because there are a lot of questions around that, particularly on, in a sense, around the qualification and the compensation. So how do you feel, I mean, the compensation structured finance stacked against the investment banking space? And typically, again, from a career satisfaction and work-life balance.
Okay, that's an interesting question. So each of these are actually different, will have different answers. Now, see, and I'll take the interesting, the one which I'm particularly uh, interested in talking about is satisfaction. The career satisfaction point of view, at least my personal feel is that it is a phenomenal place to be. One is it is intellectually very stimulating. It is intellectually very stimulating. Every time you encounter a new situation, you are deal with areas you learn new things, and I'm still learning. You learn new industries, you learn new areas, and you are. It gives you the most important uh, uh, path to a very important discovery that we are about decision making in uncertainty, and with limited data, with understanding of what needs to be done, with complex issues involved, and getting deals across. So it tests you in every single thing: your knowledge, your understanding, your capability of bringing people onto a single point, single platform, getting people, getting consensus across, and it is tremendously satisfying, intellectually stimulating. There is no doubt about it. Even though you have to put a lot of hours, hard work, and but then you don't feel much of it as long as you're passionate about it. And is it exactly a classic what you can call it now in today's market, in financial market, is nothing called a 9 to 5 job, but is it a classic 9 to 5 job? It is not, and it is something which I personally, and you can talk about these things probably a lot more in personal terms. I personally look at it is that you should, when you get up in the morning, you should be excited about going back to your desk, office, or of course in work from home before your laptop, and this keeps me fired up.
So anything around the compensation role you want to
See,
talk about? Does it
it's
compare
a
to investment banking? Yeah.
yeah, okay. So see, in structured finance, investment banking, there's a lot of areas which are blurred there. So in many areas, uh, traditionally investment banking has been kept. A lot of people have dealt it with as if it is purely equity or M&A and all that. A lot of structured finance components are debt investment banking, if you look at it. In many, if I particularly see from a debt angle. So are put from a comp perspective, uh, there's a wide range. Is it very different from what you have in investment banking? I would not necessarily believe so. I would believe that It is very similar. Very similar also in terms of in some areas in career trajectory, very similar in the org structures, and very similar in terms of what the difference is essentially in the length and breadth. It touches a lot more in a lot different areas compared to specializing in particular areas in investment banking. But can I say that investment banking and structured finance are two completely different areas? Not necessarily. In fact, a lot of lines are blurred.
Thanks for that, Saurav. And now, let me just come to the lateral side of it. I mean, there are a lot of questions around, you mentioned about CFA program and how it helps. So if somebody has a CFA designation and a lateral kind of experience in, looking at a corporate finance or some or product control or risk reporting with about say 5 to 6 years experience, does that enable some kind of jump onto structured finance? Are these kind of experiences you find useful?
I clearly do find it useful. For an example, see, uh, as long as you have a classic product control market risk framework, what you just need to probably see closely from a perspective that how much you have an important role to play in illiquid asset valuation, understanding, control, all of this which you deal with in product control on a day-to-day basis. Probably you might deal if you're working in product control in a classic liquid trading setup, you'll probably have many more references. Your job becomes challenging when you are looking at it from an illiquid perspective. But then, if you have looked at it, you are looking at it, you are developing, you have skill sets to understand that. It becomes a very important skill set when you are working with traders, working with risk managers, and they find a significant amount of value in that. They also there is also significant. It also depends if you are interested in moving into credit, and particularly structured credit where there is or structuring where there's risk distribution involved. Your earlier experience in that area helps. So I've seen people who have been in market risk, who have been in product control, moving to this area. So I can't see any reason lateral movements can't happen from there.
Excellent. Thanks. Also, one more question in terms of, about qualifications. Is there some specialized certification or qualification available? Like I remember a regulator actually warranting some kind of a qualification for valuers. So you mentioned valuers in, kind of specialist in the structured financing roles that are available. So are there anything specific to structured financing other than that that you have?
So from a financial investor perspective, I'd speak, unless you go into the whole ecosystem might have certain other requirements. But typically, no, actually no. And that is one of the beauties of being in this area. I know people who have been counsels who really are not from finance background. One of my seniors, and one of the most knowledgeable traders I knew was actually a lawyer. Is actually a lawyer, and he runs a large portfolio of structured finance. And the entire area is pretty open to people to come from varied backgrounds, experiment and go into different areas. So it has nothing to do with there's no particular certification is required. Entry level people look at a finance qualification, which is all right. At lateral level, I've seen people who have come from completely different industries, and I've seen people who are from research background, from very different backgrounds.
We don't have really too much time now, but just one question on the investment side of it, Saurav, which we haven't covered. One, that is typically structured finance. I think one of the interesting question is that even market-linked debentures, which are very popular amongst the HNIs, are also part of structured finance. And so, any particular insights you want to give, because the evolution of such products is also at very I think a nascent stage. So anything that you would want to, is there some kind of a specialist role there? I mean, what kind of roles are available in that kind of market?
See, market-led debentures had an evolution on a very different for a very different reason, very different way. A lot was related also to the taxation itself. So, but nonetheless, look, is it by being used by corporate counterparties as a financing tool? Yes, it is being used. Does it provide diversification benefits for certain investors? It does. Does it provide diversification benefits for certain corporate counterparties in terms of bringing in liquidity? It does. And is the risk classically different for them from the usual risk parameters which are there, and the returns both? Obviously, risk for someone is return for someone else. Is it different? Yes, it is. Uh, is it a large part or a significant part of structured finance market? It is not. So if you look at the significant part of structured finance market, I think it's the best way to put it is debt, different forms of debt, and different uh, types of participants. The end use itself many times will give you a much broader inkling into what drives this market. For an example, securitization, parceling out of risk. If you look at acquisition financing, if you look at, uh, for an example, distressed financing, objectives define a lot about the evolution of the market itself. MLDs have a comparatively limited objective.
Yeah, thanks, Saurav. As a last question, I mean, anything that you want to share with our audience in terms of to provide if they are interested to learn more about structured financing, any book, good book that you'd recommend, or any investment person you want to follow?
Okay, it's I'll put it slightly differently, and I'll put it this way. See, it's a broad area. As long as you're excited about, I mean, I will put it the way I feel about it. As long as you're excited about discovering new things, it's and sort of ready for a broader range of subjects to be dealt with. Read a lot about it. You can take any of the subspaces and study about it. You could look to develop familiarity, read a lot about securitization. It's one very interesting area which is coming up. New regulations have come out about loan transfers and all. Read about loan markets in India. If you want to know more about structured instruments or structured, particularly in the bond side, you could look at the information memorandum and related information about the listed rated bonds, which are under regulations basically on different platforms like NSE and all that. There is no one single book which I could talk about on structured finance. I would suggest know a lot more about ecosystem. Choose the area of your interest. It's a vast subject. Choose the area of interest and read about it. It is exciting. It is interesting. And when you look at different a good way sometimes which I do you look at different financing requirements when you encounter by reading about it or by dealing with clients. Think about what is the way, what is the best possible way to deliver. A lot of it is about thinking, about structuring, uh, and about doing the mental exercise given the framework and given the most efficient way of delivering it, and you will start developing a knack of what it is about.
Yeah, thanks, Saurav. With this, I think we will bring the today's session to a close. And once again, thank you for your time and sharing your insights with us today. Very, very useful, particularly because this subject is, more discussed, but very little understood. I'll put it this way. And I think you did a lot. You did really invest a lot of time in terms of educating us in the esoteric, as I put it, art of structured finance. For the listeners, please do, and the attendees, please do complete the evaluation survey that has appeared on your screen at the end of the session. Also, for CFA Institute and CFA Society India members, you may claim professional learning credit by logging in on the online professional learning tracking tool. So, coming webinar, once again, I want to repeat that there is a one coming up on 21st October. That's a practitioner's insights on investing in mid-cap by Harshad Patwardhan. So do attend that, and there's a link provided to register. Please do it. So thank you for participating in today's webinar, and see you again the next time. Thank you. Thank you all.
Thank you very much. Have a great day.